Shout out to In this video, I'd like to talk about the red flags and what triggers the IRS audit. I am licensed by Treasury Department in the area of taxation. I'm practicing over 30 years in the state of California. The major areas that trigger the IRS audits are income and expenses are not in balance. For example, your Schedule A itemized deductions are not proportionally with your income, or sometimes the Schedule A is much larger than your income, which also is a gray area. Acquisition loan, if you have a loan, mortgage, and if it is before December 16th, 2017, which is Tax Cut Job Act rules, then you have $1 million limitation for the acquisition loan, and married filing separate is $500,000. But if you have new loan after Tax Cut Job Act of December 16, 2017, you are limited to $750,000 for married filing joint, $375,000 for married filing separately. But if you refinance and your balance of the loan is 1 million or less, and that was a grandfather loan or it was before 16th of 2017 December, then you still have a limitation of 1 million married filing joint. And this is the area which it's important to consider. Also, after Tax Cut Job Act or during that time, the mortgage lender issued 1098, which it shows the location of the property which you have borrowed money, the balance of the loan beginning of the year, and also the total amount of the mortgages. So these are the areas that you have to be careful. If you are borrowing money, that address of property, everything is going to be matching area of the government agencies from the third party that's reporting. And another area which is important in the area of the Schedule C, for those that their business and individual return are the same place. So Schedule C, they are using the home use of business is allowed by government, but has to be reasonable. The amount of deduction is based on the square feet of the property, home, rental, whatever that you are using has to be proportional. And this is the amount of the reasonable amount is very important. Which how many square feet of the home you are using, and then you might be able to use utility or some other related areas to that square feet of the home that you are using for business. And also when you are using automobile or trucks in business, you have to be careful about the percentage of the business use and percentage of personal use. Using 100%, it might be triggering some kind of audit. So unless you have another car exclusively just for the business and used for business, parked on the location of business, and so forth. And also another thing that because of third-party reporting to government agencies from 1098, 1099, 1099K, K1, you have to be careful. The 1099s, if missing or the amount is less than what you're reporting, it might trigger from matching government agencies' reports or question or examinations. Therefore, the amount of the 1099s, that is for interest, dividend, or miscellaneous income or other income or rental income, has to be matching with the government, because third parties are issuing this kind of forms to government, and at the end of the year they have matching. Another area which is passive activity limitation. What it means is that passive activity is like a rental property. If you have a rental property and you have a large amount of losses, let me say 25,000 or more, if your income married filing joint is above $150,000 a year, fiscal year, then you are limited and you cannot take a penny of the losses because your income is above the threshold of $150,000. Providing also that you have to active participant. If the married filing joint is under $150,000, then you are limited to $25,000 of losses to take from the property. The only way you can be allowed to use it over $25,000 is that if you are material participant, which there are some certain rules for material participant. They have to have some certain hours and meet some criteria and rules. And also these persons or people that they are doing this, they are real estate professionals and their job exclusively is for the real estate, then they don't have any limitations. And another area which I like to talk is very important is the S corporation, because S corporation is a pass-through entity. Federal doesn't pay taxes and pass through as ordinary income to individual. And every people or anybody that having a S corporation, officers, shareholders, they have to have reasonable salary. Under Tax Cut Job Act, the reasonable salary came to 70% of the net. For example, if you have $100,000 of net income, under Tax Cut Job Act, they ask for reasonable amount of $70,000 salary. But I will say anything above $50,000 is reasonable. Why they are asking for reasonable salary? Because when you have the pass-through as ordinary income, you don't pay any taxes on the corporation level, and it's passed through as ordinary income, which you're paying only federal and state taxes. So in this case, you don't pay any social security taxes, which the social security taxes basically for 2021, the threshold is $142,800, and for 2022 is about $147,000. So with passing through and not paying the social security taxes, government might question, because there is no social security taxes paid without that and passing through. So this is very important area, which I have noticed many people, many S corporations, they just pass through, and that is possibility is a very sensitive area. It might trigger some kind of audit. And another area which very important is not reporting foreign bank account or the financial activities. And any individual that asset worth at least $50,000, they have to report on 8938 annually, and this is the important area which must be reported. And the last few years, there is the area of use of digital currencies and cryptocurrencies and not reporting. Now there is third parties that are reporting those cryptocurrencies, and the first page of the 1040 or federal taxes asking, did you or do you have any kind of cryptocurrencies, and then the detailed command question. So those that they are dealing with the cryptocurrencies and also digital currencies, they have to have reporting as ordinary income, and they have to report it. They do not ignore that area. And also, when you're amending your tax return, it is okay to amend it. But remember, you are opening a statute of limitations. For IRS in regular cases, 3 years for the statute of limitation, unless some special circumstances come up. So with amending your tax return, basically you're opening up a statute of limitations for whatever that you have opened. So it's become more than 3 years. And another important area is when you hiring person to do your tax returns, and they are falsifying your returns for larger refund without sufficient financial support, is very important to be careful, because this also by itself, it could trigger a tax audit, and it's a red flag. Thank you for watching and listening. Bye.